It is known as the Super Bowl of all mortgage events. It is the Mortgage Bankers Association's annual sales conference, aka MBA Annual. And I just spent 3 days in Denver with 3,000 plus other mortgage professionals. And these are my biggest takeaways about the future of mortgage lending, all because I spent 3 days in Denver. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC
John Coleman.
Dio, what is poppin'?
I do want to say shout out to John and Joe Mata-Whitlock with Empire Financial. They're putting on Mortgage Con in February 2025. We're going to be podcasting with John here soon so we can learn more about this great event. I also want to learn John's story because this guy started his own mortgage brokerage just a few years ago and he's now franchising it out. So there's going to be some cool business and life lessons that we're going to learn from John, but we're also going to give him an opportunity to promote this event because it's going to be, I'm looking at the lineup, a really awesome, well done event. So if you're looking for a cool mortgage event to go to, and you're in sales, whether you're a broker or you're a mortgage banker, I don't think it really matters looking at this lineup, check out what they're doing over at Mortgage Con. And we're going to be talking a lot about Mortgage Con leading up to the event because I'm going to be there speaking. The TLOP crew is going to be there representing. Also, shout out to Kate DeKay over at Eustis Mortgage.
Okay.
She was one of my new connections. Actually, I met Kate for the first time last year at MBA Annual, but we had a chance to actually get to know each other better at this particular MBA Annual, and Kate reached out to me last week, and I'm actually going to be flying to New Orleans in January.
Oh, shit.
So that we can represent for the guys and girls over at Eustis Mortgage. They're going to have their annual sales conference, and yours truly gets to do an hour keynote.
Craps at Harris.
Possibly, who knows? Who knows? So anyhow, today's episode, okay, got the two kind of shout outs out of the way. Today's episode, I really do want to kind of talk about what it means to be a part of your industry organizations. And your industry organization doesn't necessarily have to be MBA, right? It could be NARREP. It could be NAMBA. It could be FAMP, right? I mean, it could be AIM, right? Shout out to Jonathan, by the way. Jonathan had over at AIM. He's one of my new connections that happened because he and I both knew of each other but didn't know each other personally. We both go to Denver. We both go to this event. Voila, a bromance is born. Right. And Jonathan just sold his brokerage to NerdWallet. So, dude, kudos and shout out to Jonathan. But he heads up AIM. So being a part of an organization like AIM is being a part of your industry and advocating on behalf of your industry. So this is a big event for me to go to because I've been a part of the MBA for, most of my career, at least the past 15 years. And I'm talking, I've been a local chapter president, like the Central Florida MBA. I was a chapter president, which in order to do that, you have to go president-elect, president, and past president. So it's usually like a 3-year commitment.
Oh, wow.
I've been a director for the state of Florida at least 6 out of the past probably 10 years. So I sit on the board of the state of Florida. I've done things with national MBA, whether it was going through their programs, that's the Future Leaders, that's the CMB, that's obtaining my AMP, which is School of Mortgage Banking 1, 2, and 3, going to advocacy conferences, but I've even been really involved in MORPAC and MA. Like, it's really benefited my career being a part of our trade organization. And I know when I talk to my friends over at FAMP, or I talk to my friends who are involved in AIM or NARREP or one of the others, they will tell you that networking within your industry is equally as important as networking with those outside of your industry, depending on what side of the coin you're in. So for those that could not attend the event in Denver, let me just kind of walk you through my play-by-play and talk about maybe some of the things that you missed.
Nice.
Yep. So on a very high level, here's what I'll tell you. The overall sentiment, the overall mood, and you got to think there's 3, maybe 5,000 top names, executives pouring into Denver for this event. Like, I joke about it, but literally, if you were like a serial killer and your target was white dudes between 45 and 65 wearing blazers, you would have absolutely had target practice. You would have ran out of ammo because they were everywhere. Like, you knew this was a banking convention just by looking around at who attended it. But you have all these people pouring in, and we're all here to network. I'm talking like Fannie Mae is there to talk to the clients that sell them loans. Warehouse lenders are there to talk to the clients that use their warehouse lines to fund loans. You have every technology vendor there either to see and thank those that do business with them, or they're looking to find new clients that want to leverage their technology. Every investor that your bank or lender sells loans to, they were there, A, because they want to meet with their clients, get some face time, but B, because they're looking for potential new clients. I mean, it is the Super Bowl of events. So the overall sentiment was just this. When I compare 24 to 23, 23 was definitely a lot more solemn. In 23, this is October of 2023, we are in Philadelphia. I heard people saying things like, we have to survive for 25. And I didn't quite let that sink in. I'm like, nah, survive for 25? They're like, yeah, survive for 25. Like, these are some of the smartest people in the room. And in October of 2023, they knew 2024 was not going to be a robust year. They thought it could be better, but it wasn't going to be like robust. And better was better than what 23 was. And it was only going to be better because we as an industry right-sized. Okay, it wasn't that, volume was going to be better or units were going to be better. It was just going to be better because we right-sized, because in 23 we were overstaffed. Therefore, many of us were unprofitable. In fact, I think the mortgage industry went 8 consecutive quarters of not making money. It wasn't until 24, and I think it was Q2, that the industry on average made money. So I think the industry on average made money in Q2. I think it's going to be reported that we made money in Q3. I'm not confident about Q4 and not confident about Q1. Now, that's pretty typical in the mortgage industry. So what does that mean? So here's what all this means. The overall sentiment going into 25 is definitely more positive than going into 24, but nobody's doing backflips. But who doesn't like positivity and momentum? I sure as heck do. So that was a big takeaway. We need to prepare for a potentially not profitable Q4 of this year and not profitable Q1 of next year, which means that there are going to be some companies that still aren't done right sizing. They still, whether it's eliminating leases, whether it's consolidated branches, or whether it's getting rid of staff, that is going to transpire. And overall, though, the MBA is predicting that volume is going to be up by like 20, 30% next year, and that units will be up by like 1.5 million. So 1.5 million additional units will be a huge positive, especially when you look at the landscape of if there's going to be some more consolidations, if there's going to be some more acquisitions, then you're going to have less people chasing more business. You always want that, right? The 2022, 2023, 2024, we had too many people chasing too few loans. Hopefully by 25, we'll start seeing either the right amount of people chasing the right amount of business, or if we get lucky, we'll have too few people chasing more business. So it's going to be something that we want to keep an eye on. But when you talk to those that focus on mergers and acquisitions, like shout out to Garth Graham over at Strapmore Group. And when you follow guys like Garth, Garth will prognosticate that there's going to be more mergers and acquisitions in 25 than there were 24. So this is going to be companies that are coming together to merge or companies being acquired. Like our company, Lower, was a big acquirer in 22, 23, 24. Like we acquired smaller independent mortgage companies that, were for whatever reason in a position to be acquired. And in 24, we didn't see that much happening. And I think the reason why is that there's still a good percentage of company owners that they want out. They don't want to cash out. They want to take their ball and go home. They want to take their chips off the table or whatever the case may be. Or they're just kind of done. They've run through their savings. They don't want to invest in technology. They don't want to invest in the new ways of lead generating. They don't want to be a part of the 2030s. They are very grateful for everything that the 2010s and the 20-teens gave them. But at this standpoint, it's just time to cash out and check out. We didn't see as many in 24 as we think we'll see in 25. And the reason is there were a certain amount of people or company owners that were willing to hold on, kind of like Mel Gibson in a Braveheart, hold. And then when we can get a couple profitable quarters underneath their belts, when we can start to see some positive momentum, start to see some pipelines fill up, they think they can get a better price in 25 than they could have gotten in 24. Maybe the price in 24, the offers were so low ball. They're like, you know what, dude, peace out. I'm not going to sell it at this level. Let me see if I can get a better price in 25. So that's something that we're going to keep an eye on. And that was a very high level view of kind of the overall sentiment of being in Denver with basically all of the top companies and all of the biggest leaders in the industry were all at this event. They were speaking on stages. They were doing breakout sessions. They were doing one-on-one meetings. We were going to check this out. Like, this is so up my alley. Every night. Like, I got there Sunday.
Smacked.
No, not smacked.
Damn.
I mean, drank, yes.
Okay.
Yes. Smacked, not so much. Still have a certain level of executive sales
Were there any
professional.
stumblers in the lobby? Were there anybody who's like, hey, cut out
I'm
Jim?
sure yes. I was in bed before midnight every night.
Good for you.
Yeah, that's my rule. In bed before midnight.
Well, technically you're in Denver, so really it's 2 a.m., but we're not. Who's counting?
Well, Sunday whipped my ass. Like, I woke up Sunday at 5:30 Eastern, took a shower, shaved, put on my suit, and flew my happy ass to Denver. I landed at 10 a.m. Denver time, noon, Orlando time, but I had an 11:30 meeting with the future leaders. And this is like one of my favorite things to do. In fact, if you think you are a future leader in the mortgage industry, you should look at the Mortgage Bankers Association Future Leaders Program. It's very selective. It is very elite. They only accept something like 30 to 36 participants once a year. And this program runs from April all the way through October. And it culminates with the groups presenting their project to a board of directors. It's a fake board of directors and it's a fake company, but they have a 3-month project they have to work on. It's a 15-minute presentation and then 15 minutes of Q&A. You're basically presenting or pitching your idea to the board, then the board's going to grill you with questions. Well, I get to be part of that board. So it's me, it's Peter Benjamin with Akuma, it's my girl Jen Green with Tennessee Housing, and it's the MBA's one and only Marina Walsh. And that's the panel. It's the panel last year, it's the panel this year, and I sure as hell hope it's the panel next year too, because I have too much fun doing it. But yeah, I got to the airport in my Uber to the conference center and slid in just in time. That event ended at 4. Well, at 4, I then have to go check in on my hotel. Then after I check in on my hotel, there's some reception to go to. I go to that reception. I leave that reception. Then I go meet Randall Gillespie and Dave Savage and some of Dave's crew for dinner. So shout out to Mortgage Coach, Trust Engine, Dave Savage. And then I leave that. And there's not one, but there's 2 receptions that I'm invited to go attend. Well, I can't say no.
No, you can't.
So I go to one reception, then I leave that reception. I go to another reception. And these receptions, these are our boys are there, right? So Chad Gomel with Arch is there. Then I run into Ken Perry with Knowledge Coop. Then I leave that event. I mean, it's right up my alley. But truth be told, I go to bed 11:30 that night, which is really 1:30 back in Orlando. 21 consecutive hours, nonstop, in the same damn suit that I put on at 5:30 in the morning after I took my shower and shaved.
You could wrestle in the WWF with that kind of schedule.
Probably could, right? I probably could. That was hardcore. And Monday and Tuesday weren't any different. Monday and Tuesday, you're getting up at whatever time, 8:30. We're really 6:30. But it's 8:30 Denver time. You have your first meeting at 9, and then it's just go time. And you're not going to bed till 10:30 or 11. And I'm sure there are some people that go to bed at 2, 3, 4, or not at all. All right, so there it was. I kind of got off track on everything that transpires. And maybe I'm just trying to hype people up. Like if you're into this type of stuff. Now, granted, this event, truth be told, it is not built for the average originator. I think the people who go here, they're high-performing branch managers and above. And as a high-performing branch manager, you're probably really involved in the industry, right? You probably run some MA campaigns. You probably donate to MORPAC. You're involved in your local MBA. And you do want to go and listen to the speakers and be a part of some of the breakout sessions because you view yourself as something larger than running your own branch, because maybe you want to run a region. Maybe one day you aspire to run your own company or run the company you work for, right? And this may be a part of your career trajectory, and you want to now start building those relationships with those men and women within the industry that are going to help you advance your career, right? Whether it's start your own mortgage company, whether it's to be a great leader within your current mortgage company, or maybe it's to increase your role at a different mortgage company. Like those are the types of I think conversations you would have and the type of people that would want to go. But when you go, I hope you're into networking. I hope you're into almost like speed dating from a professional standpoint and having 5 receptions a night knowing you can only get to 3. So I hope your FOMO doesn't kick in because you're going to have to pick 3. You can't pick all 5. It's like logistically impossible. And oh, by the way, your feet, your shoulders, your back is going to hurt the whole entire time because you're walking, like everywhere. Miles. Every day you're just walking from one reception to the next, from one dinner appointment to a lunch appointment to the conference because you want to see this one speaker back. Like that's kind of what the event is.
What did you hear? Did you hear anything at the event that really like surprised you, or something that you didn't anticipate to hear that you could share with the audience?
I mean, on the nerdy side of things,
get nerdy.
All right, on the nerdy side of things, it sounds like Fannie and Freddie are going to try to increase the number of PIWs that we get through AUS, right? So when you're originating a loan and you run it through automated underwriting, whether it's DU with Fannie or LPA with Freddie, then we sometimes can see a PIW, a property inspection waiver. Basically, it's an opportunity not to have to get an appraisal. Okay, and what Fannie and Freddie are going to attempt to do now they have more data, and what they announced at MBA Annual is that they are going to loosen up their algorithm to promote more PIWs, so that's something that we can be on the lookout for. On the second thing, on the nerd side of things, is that if you follow our industry not only was kicked in the junk starting probably Q2 of 22 all the way through right now, we were kicked in the junk when rates skyrocketed, when affordability became an issue, when inventory became an issue, and there were just no one was selling, therefore no one was buying. Like that was a big issue. All of a sudden, like we can't make money if there's not enough units. When we have too many people chasing too few loans, you then end up with those that are winning the deals are doing so at such a low profit margin, they're potentially putting themselves out of business by actually doing the loan. They would have been better off not doing the loan at all because they're doing the loan not at a profit, at a loss. So something else that was attacking the mortgage industry that the street originator didn't necessarily see is the company that they represent was getting all of these buybacks. That broker, that wholesaler, that third-party originator that they broker loans to was getting pummeled with buybacks. And it was punitive. And some of the buybacks were coming back at one point because of a backlog. They were coming back from loans that were like vintage 2021, and the buybacks were coming in 2023. And a buyback is essentially Fannie and Freddie saying there's a deficiency or a defect on this loan that you sold us. We want our money back. Take this loan back. Well, if you're running a mortgage company, I don't care if you're United Wholesale getting buybacks or you're a small independent mortgage banker who does $1 billion a year in your tri-state area. When you get a buyback, it's essentially you are taking a massive loss because you now have to put that loan on your books, and that loan on your books isn't worth but 70 cents on the dollar, because who's going to buy that loan if it's not backed by Fannie or Freddie? But Fannie and Freddie said, we're not going to buy this loan that has too many defects. So either fix the defects and sell it back to us, or you can't fix the defects, at which point it's just going to sit on your warehouse line, at which point you pay interest on, at which point that prevents you from being able to lend any more money, or you sell it scratch and dent and you just write off that $50,000 or $60,000 loss. So buybacks were very punitive. Well, Freddie came out and said, we're actually going to roll out, it's actually a way they used to do things in the past, but they're going to make it easier for lenders to work with them on a buyback. That was it. So that's like, it's less punitive. Less punitive means it's less of the little bit of money that you do have sitting on the sidelines if you're running a company. It's less money that you have to push through some kind of a scratch and dent sale, because maybe Freddie will work with you to fix your issue, or they'll find a way to still buy it, but maybe they won't buy it at the same price. So that was and I'm trying to oversimplify it without geeking out too much. Just know that if buybacks were an issue, they still will be an issue, but Freddie and potentially Fannie, but Freddie definitely is going to be willing to cooperate and make it less punitive. So that's good overall for the mortgage industry. On top of that, the MBA is really pushing on better clarification around RESPA, especially RESPA Section 8. And so that's the real estate service provider. Oh shit, Dustin, I should know this. RESPA.
Association.
No, Act.
I knew I had it.
Act, yep. So in RESPA Section 8 is essentially what regulates how service providers and lenders can coexist, but it's also what states I cannot pay a real estate agent for a referral. That's the easiest way to what's RESPA Section 8? It's what eliminates quid pro quo. It's what prevents me from going into John Coleman's office saying, hey, John, for every time that you send me a referral, I'll pay you $500, right? That's RESPA Section 8. Well, the MBA and Bob Brochman and his entire team, they're starting to come out and really state that, look, this was written 50 years ago. Is it needed today? And if so, is the way that it was written 50 years ago the right context? Mm-hmm. So that was discussed a little bit, whether it's on the main stage or a lot of these conversations, just those of us talking behind the scenes. I talked off the record with several people about loan officer compensation violations, just getting their thoughts on it, what's happening in the industry. Are companies actually being reprimanded? And the answer I was given was maybe, but they're going to do everything they can to keep it under wraps. They're going to do everything they can to keep it out of the press, and they're going to do everything they can to make it go away. And then, meaning they'll pay their fine, they'll make it quiet, then they'll change their policies internally. And I even asked a question because I was just curious. We've had in our industry these class action lawsuits where ex-loan originators have sued, and this has been happening for going on 20 years now. It's under the Fair Labor Standards Act that a loan originator who's 100% commission would sue their former employer, or their current employer, but usually former, for unpaid overtime, which always baffled me because it's aren't you 100% commission? Shouldn't that be exempt? But the way that the law was written back in 1932 or whenever it was written, a banker was excluded from, or was included in the Fair Labor Standards Act, meaning if they worked overtime, you had to pay them. Well, I had this thought, so I started asking some people, and these are usually at these evening receptions or in the hallways. I'd be like, hey, I'm curious. I haven't read about this yet. I even asked James Kleiman over at Housing Wire if he's heard it, because usually James has the scoop, which is why I love Housing Wire and say y'all should be subscribed to Housing Wire, getting their daily emails and reading their articles, because James and the rest of the team over there, Sarah and Flavia, etc., they have the scoop. So I was asking even James, I was like, hey, I haven't read anywhere where a group of loan officers have got together and sued their usually former employer for unpaid wages. We talk about loan officer compensation rules potentially being openly violated throughout the industry. I mean, James Kleiman wrote about it a year ago. You and I have been talking about it on the podcast for over a year. At my old company, I would bring it up pretty consistently as hey, should we be concerned about this? Have our attorneys vetted this type thing? And I was wondering, I haven't read anywhere if an originator has gone back to their employer and stated something along the lines of, hey, in 2023, I closed these 4 loans and you paid me less on those 4 loans than you did these other 12 loans. I want my money, and I want the interest, and I want the penalty. And oh, by the way, I brought 14 of my friends who also closed 16 loans in 2023, 4 of which you paid me less than you did on the other 12, and I want my money. And the answer I got was, I guess, on part of what I was anticipating. And the answer I got was, there's been nothing confirmed, but we have heard of such going on behind the scenes that's potentially trying to be settled. Again, how do we keep this out of the national news? How do we keep this out of the trade publications? And how do we solve for it? Because I know, like, I don't run a mortgage company, right? Like, I'm a part of Lower, but I'm not Dan Snyder. I'm not Mike Baines, right? I chose when I was leaving Waterstone not to go start my own mortgage company, but to go join that one that was already founded. But I know if I was running a mortgage company, I guess I'd have to go with my attorneys and we'd have to mitigate that risk, right? We'd have to mitigate, it's like you do in every business decision, you mitigate risk. So that was something that behind the scenes, I didn't hear on the main stage, but there were conversations that were being had in the hallways or late at night at the receptions. You know, hey, what's going on with LO compensation? What are you hearing from the CFPB? Are they actually going to step in and regulate? And then, by the way, if we're talking about LO compensation, has there been any evidence or any scuttlebutt of, and usually it would be ex-originators coming back after their old employers claiming they were short paid and now demanding that money be paid? And the answer I got was nothing is being spoken about, nothing is being written about, but behind the scenes, wink, wink, nod, nod, potentially that could be going on. But if that's going on, those companies that are impacted are doing everything they can to rectify the situation, to settle, and have it not make the national news and have it not make the trade publications. So that was something that went on. You know, my favorite part of the conference, besides all the receptions, and honestly, it truly is for me, seeing all of my friends. Like, literally, whether it was Donna, whether it was Greg, whether it was Brian View, I was walking the street, and I want to give a huge shout out. Taryn Reuter and Eric Lovins, Luminate Home Loans, Luminate Bank. Like, those dudes and I grew up in this industry together. There was a point we worked together. We were OG at Waterstone Mortgage, like along with some people like Lisa Wells and Brian Clute and Eric Egenhofer and, you know, really Mike Smalley, like a core group of us really helped create and build that company into what it is today. Well, those guys have gone on to literally be a fractional owner in another mortgage company. They left that mortgage company, started their own mortgage company. Then they bought a bank. Now that bank owns their mortgage company, and it's called Luminate. They do a really good job. And one of my highlights was actually running into them on the street. Literally on the street, we sat there and talked for 30 minutes. Like, I see Taryn probably once or twice a year at various conferences, but I don't get to see Eric very often. And what I love about both of them is they're huge TLOP fans, so that makes it even more fun. But like, I'm fans of theirs, they're fans of me as friends and as ex-colleagues, and we respect each other. So like, that was a highlight, but that wasn't the highlight I was thinking about.
Okay.
The highlight that I was thinking about was actually seeing John Boehner speak on stage, being interviewed by Bob Prochman. Like, that was probably one of my highlights. Do you know who John Boehner is? If you don't, it's okay.
I do not.
Okay, very good. John Boehner was once the Speaker of the House. Okay, he's a Republican from Ohio. And John Boehner is probably somebody that when he was a speaker, I may have not voted for him. Right? I never lived in Ohio. I never knew who he ran against. And I am as middle of the road as they come. I'm purple. I'm a registered independent for anyone who's actually wanted to know. So like, I don't have a party affiliation on purpose. But I don't know if I would have voted for him. But I can tell you this. I tell you, he seems like a good man. Like, in terms of, like, we all have our faults, right? So please, no one's like, oh my God, I knew John Boehner and he was no. He just seemed like a normal human. He seems like a man who cared about his country. And it was so awesome for me. He told stories about his 25 years in the House. He talked about the political landscape today. And because he's no longer running for anything, he is retired. It's so nice to see a politician not have to perform. It's so nice to see the human but behind it, and to have them speak real. And he's telling stories, and he's dropping F-bombs, and he's telling stories, and he gives a double middle finger to the audience, but it was as a hand gesture to what transpired with the story. But I really, really dug what he had to say, and it probably came down to, and it spoke to my heart, how he concluded. He concluded to where he reminded the audience that regardless of the political outcome, presidents have way less power than they would like you to believe, and way less power than you believe, right? Like the power comes from the people. The power comes from the House and the Senate, so it comes from Congress. And presidents typically only sign into law the bills that were already approved and negotiated by Congress. And, we're going to have a split Congress. And even if we don't have a split Congress, we are going to be at such a small majority, and that most major things require, like in the Senate, 60 votes or 60%, that at the end of the day, we live in one of the greatest countries. We have one of the best economies. The world looks up to us to be their leader. And democracy is alive. Democracy is well. And that all in all, things are good. And we have a lot to be proud of. Now, is anything ever going to be perfect? No, but the system was designed for it never to be perfect. And do we have a major deficit issue? He's like, hell yeah, we have a major deficit issue. Like this is the elephant in the room. He said, and it hasn't been addressed in 3 administrations. So it doesn't matter if it's red, purple, pink, or blue. Ain't nobody over the past 3 administrations, and nobody currently is talking about what they're going to do to lower the deficit, right? Because all we want to do is spend more money but pay less in taxes.
Yeah, what's wrong with that?
Yeah, he said, would you ever run your household that way?
That's how I run my household to this day.
Yeah, go spend more money, but while you spend more, make less.
Yes.
Yeah, and then what happens? Eventually you end up bankrupt.
Live life. Eventually. If I can live life, no stress. The hell's wrong with you, man? What the fuck? Yeah.
So he said that's going to be a big pill for anyone to swallow, and that regardless of who wins and what administration, that is going to have to be addressed. And the longer it takes to address it, the more painful it'll be when we're forced to address it. But I just really appreciated him speaking from the heart, human to human, citizen to citizen. There was no agenda. There was no politicking. There was no money raising. He didn't have to pander to one particular group so he could get their votes. No, he's 76 years old, and he's like, I'm just going to sit here and tell you like it is. The world, according to John Boehner, based on his 76 years on this earth, his 25 years in the House. I appreciated that probably more than most other things. So that was MBA, man. That was this year. If you want to know more and like what you missed, I plugged them before, but like read Housing Wire. Housing Wire does an amazing job of I'm talking like sometimes by the hour, giving a play-by-play in a write-up of everything that was transpiring at MBA Annual. So like if you can attend it at a minimum, make sure for those 3 or 4 days that you are reading the trade publications. And my favorite trade publication to read is Housing Wire.
That was amazing, Dustin. So amazing that I don't have any jokes or questions to ask you about this episode.
Perfect. So my one last plug, and I told my buddy Craig Montgomery I'd do this for him.
Okay.
So you and I made this big splashy move over to Lower about 90 days ago, right? So it's been about 3 months.
Oh, shit.
And we talked about it. We did an episode about it. We featured some of Lower's best of the best on the podcast because I felt like they made phenomenal interviews. So, shout out to Lauren, to Dan, to Patty, right?
And
to John, right? So all 4 of them took time out of their day to sit down with you and I, let us pick their brain, tell their story, and teach lessons to our audience. So Craig Montgomery came over from cross country right before I came over from Waterstone, and he's our chief strategy officer. Like this dude has the playbook that is going to allow us to attract those all-stars that we seek to attract as we build out this top 5 lender. And we have recognized that in order to do so, we have to help each individual loan originator and each individual branch become top 5 in their market. That's our focus. If we can do that, then we can become a top 5 lender. It's less about starting from the top. We're going to start in the local markets and collectively pick up W's along the way. And as we do, it's going to elevate the entire company. So I was saying to Craig the other day, I go, man, I get absolutely inundated with just, and we promote this. I get inundated with LinkedIn messages, with IG messages, with phone calls, text, and emails where people are asking me for career advice. And I give career advice, right? And I would say 3 out of 10 times, 3 out of 10 times the career advice may be to talk to one of my friends who works where I work. But 7 out of 10 times it's not, right? 7 out of 10 times it's like we just do career advice, and that career advice may be to go talk to one of my other friends who doesn't work where I work, or it could be just have a hard conversation with the place that you currently work, or it could be to go start your own company. Like we've kind of run the full gambit. I said to Craig though, I go, but for these people who are interested, like what's the best way? He said, for them to get to know us, besides like hearing my version. He said, well, would it benefit you if I did this like low down with lower call? He goes, I'll host it twice a month if you want me to. He says, so I'll bring on some of our key players, right? VPs of ops, VPs of marketing, people who've been with the company 7, 9, 10 years. Because like you take my word for it, bro, I've been here for 90 days. I can tell you every reason why I went to lower and why it was a great decision for me in my career. But I want you to hear from the Lauren Randalls of the world, the John Cornishes of the world. I want you to talk to James Duncan or Dan Stitch, right? Like I want you. So Craig, which I thought was a genius idea. So by the way, for those that are running mortgage companies, you too should be doing this too. Craig's going to do this call twice a month where people can register like it's a webinar, right? They can log in anonymously, meaning like you won't know I'm on, I won't know you're on. But if they just want to like get the lowdown on who we are, where we're trying to go, and who we're trying to attract, they can spend an hour of their time doing so. So the first one's going to be November 21st. So now if y'all want to reach out to me for career advice, please know I will be more than happy to spend 15, 20 minutes with you. Typically it's on my drive to an appointment or my drive home is when I do them. And I will answer your questions as it pertains to your career. I'll get you pointed in the right direction. And if we decide that, hey, you should look under the hood of what we're doing over at Lower, well, my boy Craig is coming through for me and so many other people within the Lower organization that we're going to have these calls. So if you want to be a part of that call, it's going to be November 21st. It's the first one we've ever done, but it's your way to kind of get an inside look into what we're doing, who we think would be the right fit, who would not be the right fit. And it might be someone's way of looking into something like window shopping without having that like hardcore recruiting, like here's why you need to join us now type call. So anyhow, I promised Craig I would talk about that. So we can check that off the list and we can conclude today's episode. Thank you all for tuning in. Here's all we ask. Please make sure you share us. Make sure you like us. Make sure you subscribe on YouTube. Go to our website, tloponline.com, and sign up for our newsletter. It is free, and I write that shit every single week. It's full of sales tips and market updates, etc. And then finally, y'all, if you're trying to make changes in your business for the better, you probably need a coach. You probably need a sales trainer. We offer the best solution in the market when you look for value. The best value, 8 live coaching calls a month, an entire library of training videos. Go to tloponline.com and check out what we are doing with the TLOP MLO coaching community. You will not be disappointed. He is John Coleman. I'm Dustin Owen. That's all the time we have for you today, but we do look forward to catching you on the next episode.